Hi, everyone, and welcome to the State and Local Tax Outlook for 2026. I'm Jim Bartek, National State and Local Tax Practice Leader at Withum, located in New Jersey. And also with me is Jonathan Weinberg, Principal focusing mainly on income taxes in Nevada. Courtney Easterday is a Senior Manager focusing on sales tax located in New York. And Penny Sweeting, who is a Senior Manager focusing on income tax located on the West Coast in Oregon. So we have a lot of experience today to talk to you about state and local taxes. Next slide. So why should you care about state and local taxes? Before we get into the slide, if you do have any questions, please ask them, and we'll do our best to address them. If we don't, we'll answer them later this week at some point. Of course, you can feel free to call us at the contact information that we listed on the previous page. We're always willing to answer your questions. So why should you care about state and local taxes? Well, there are 50 different states. Each state is like its own country. They have different tax laws and tax types to fund their government programs, and they can be quite complex. So a lot of laws were written many years ago, prior to a lot of the digital goods that are being sold today and the way that they are provided. And the states have not kept up with the laws have not kept up with the technology. Now, state and local tax affects corporations, partnerships, LLCs, S corps, and individuals. If you don't deal with these properly, it could create significant risks for your company. And in addition, there could be savings opportunities related to sales tax or income tax planning or refunds. So it should be noted that SALT issues are often the largest issue identified during SALT, during the due diligence process. Next slide. So during this session, we're going to talk about sales and use taxes. We'll go over Nexus briefly, and then we'll talk about some compliance trends as Courtney handles a lot of sales and use tax compliance. And she'll also discuss some sales and use tax trends for 2026. And then we'll briefly go over some due diligence rules that we see on the sales and use tax side. And then Jonathan and Penny are going to talk about income franchise taxes, assessing market-based sales sourcing rules, the One Big Beautiful Bill's impact on state and local taxes, state tax treatment of digital goods and services. And Jonathan will cover SALT considerations for M&A on the income tax side, as well as state tax predictions for 2026. Next slide. And next slide. And next slide. So we're not going to spend a lot of time on Wayfair because we've covered this a lot in the past, but we need to mention it since it comes up all the time with our clients. For those not aware, the Wayfair case was decided in 2018, and it allowed states to require out-of-state sellers to collect and remit sales tax on taxable products or services if they met certain thresholds related to sales and/or transactions. It's important to note the case did not remove the physical presence standard. That's still in effect. So next slide. So now if you have physical presence or you exceed the economic nexus thresholds in a jurisdiction, you have a requirement to collect and remit sales taxes on taxable products or services. Next slide. And we do find that companies that don't pay attention to certain nexus creating activities, such as inventory. Some you may not know where your inventory is being stored. It may be held by Amazon. Independent contractors, you have repair people coming in or installers or so forth could give you Nexus. Any travel into the state, licenses or registration may trip up Nexus. Contract manufacturing is also something we see quite a bit with our clients. So make sure you're aware of the company activities around the country and you're tracking it on a daily basis. Next slide. So as I mentioned earlier, we have 50 different states. 45 do have a sales tax plus DC. 5 do not have sales tax. Each has enacted its own thresholds, economic nexus thresholds, as a result of Wayfair. Some are at different amounts. Most of them are around 100,000 or 200 transactions. Some just have the 100,000 threshold. Some have 500,000. So again, as I mentioned before, each state has its own rules. It's important you understand that. a lot of states are evaluating the transaction threshold and removing it because they are getting a lot of smaller sales and use tax returns, and they're more interested in the larger ones. So keep in mind that revenue stream is, if it's not taxable in your home state, it could be taxable in another state. So again, the key issues to focus on, Nexus, the economic thresholds, and where do you have a physical presence. Keep in mind that there are complex compliance rules, and Courtney will cover some of these. And while looking at sales tax nexus, you also have to consider other types of taxes like income franchise taxes, gross receipts, or other type of taxes. And if you register and file for sales tax, you could have an obligation just by registering for some of these other taxes. So next slide, and I'll hand it over to Courtney.
Thank you, Jim. So if we continue to flip through the slides, the next topic that we will discuss is the sales tax compliance trends updates. So if we can go to the next slide. And the next one. Anybody who's dealt with sales and use tax compliance is probably familiar with that. Every state has kind of a different way of handling the sales and use tax compliance. Across the states, there are about 7,500 sales tax rates, maybe even a little bit more. On top of that, these rates can additionally change over a period of time. So this last year, we saw around 400 changes in actual sales tax rates. But that doesn't necessarily mean that every state changed at the same time. A lot of the times we're seeing those updates that are happening on the quarters. We're going to probably see that as we continue to go into the next year, just as, cities and counties as well as states continue to reevaluate what their budget needs are. There's significant changes that we've been seeing over the past year that we anticipate we're more likely than not going to continue to see in the upcoming years, especially around the products and services taxability. For any of those that are familiar with Washington, there was a huge revamp as to whether or not certain products and services were subject to sales and use tax. And we're expecting that to kind of continue. As Jim sort of mentioned, a lot of these states were not kind of ready for the digital space when it comes to SaaS, streaming services, cloud-based software, and digital goods. So we are seeing a lot of states begin to kind of define what those truly mean in each of those states. So having a strong sales and use tax process is becoming a necessity for a lot of businesses to make sure that things are being handled appropriately. And also having people in place to handle sales and use tax, whether it's outsourcing, whether it's internally within the company, has become a huge necessity for businesses to ensure that they are remaining compliant on a go-forward basis, especially, and I'll talk a little bit about it in a moment, but especially to help mitigate audit risk. So if we can move to the next slide. The big, steps that we've seen a lot of companies take are automating the software used in order to calculate sales and use tax. Particularly where we're seeing a lot of businesses see the most favor is in the actual rate calculations. So using a software that can actually calculate the rates becomes very beneficial for companies instead of having to sit there and track all of those rates. We talked a little bit, or I mentioned a little bit about the 400 rate changes that we've been seeing over time. So, having a system that is automatically going to be updated and that system kind of takes responsibility for those updates is huge for a lot of companies, and a lot of reasons why, implementing a software to do the actual sales calculations and making sure you have the right software in play for your business is particularly important. The systems that can track and manage Nexus as well, especially with the changes that have been happening. Jim had kind of mentioned about the transactions being pulled back in a lot of states. So having a software that can actually track that and make sure that they're pinpointing the point of when you actually cross over so that you can take action is incredibly important. And on the other side of that, also a system that kind of helps and manages exemptions. I know a lot of of companies that I work with, you know, they may not be at the size right now where it fully makes sense to have an actual implementation of a software to track those exemptions, but that does mean that somebody manually has to be doing it. Somebody manually has to be making sure that they are signed, manually checking that they're completely filled out, that the actual reason why they're exempt is completed. Whereas some of these softwares that are available out today will actually check those things and validate those things prior to accepting it. So that way, you know, you have everything in play, you have everything in line that you really need in order to make sure that you're protected. Because at the end of the day, you know, collecting those exemption certificates for any business is really what's going to help and assist with making sure that you are in line when it comes to an audit, and having the support that you need. Another, you know, reason to potentially implement a software when it comes to sales and use tax compliance is going to be for the remittance side. For any business or anybody who's familiar with sales and use tax, where potentially you are filing in all states, it's a lot of states that you have to be filing by the deadline. And those deadlines vary, right? Most of them are on the 20th of each month if you're a monthly filer. Some of those can extend out to the end of the month. So, you know, it's a pretty good gap of about 2 weeks where you could potentially be remitting returns to make sure that you're hitting those deadlines. And having a software in play that actually does that for you really does relieve your people to be able to do other things in the business that might generate a little bit more revenue for the team. You know, some of the things that we'd like to point out, if we can go to the next slide, that you might want to consider when it comes to a sales tax software is anytime you're putting any type of automation into play, there are going to be limitations, right? There are several software companies that are out there right now that can assist with the compliance and assist with collecting. But I truly feel that each one of them kind of has their own benefit for each of the different types of clients that we really work with. There may not be a one size fits all for everybody, especially when it comes to your ERP systems and what limitations your ERP system may have when it actually comes to invoicing and also integrating your sales data into that actual software that is going to do the calculation, that is going to do the remittance. So you do kind of have to make sure that you still have somebody who understands on the more basic level of how these returns should be filed and how these returns should flow, ultimately to be able to kind of assist with making sure that the software that you have in play is functioning and working the way that you really want it to. You know, automation really does help with the accuracy. It does help with making, you know, sales tax decisions so that you don't manually have to have somebody sitting there adding sales tax on every single line of items that you're pushing out on your invoices. And then also double checking the rates. Like the systems that are out there right now do a lot of that for you, but they really only function and really help the company if it's set up properly, right? You want to make sure that you have the right system in play.
Yeah, and Courtney, that's an excellent point. Yeah, obviously we have a lot of clients who may use the provider to the software company to set it up. They may or may not be the best person to actually set that up. Like you might have taxability decisions to make that could be difficult. And Courtney, maybe you want to touch on that.
Yeah. So, I mean, you know, I mentioned already that there's a lot of differences that we're seeing are actually being changed in terms of taxability and what states are determining actually are subject to sales and use tax now. You know, we are seeing just as a couple examples, some states that are starting to tax digital advertising, which historically in most states has been considered non-taxable. We're also seeing a lot of changes in what they actually define as digital goods and whether certain businesses actually are meeting the definition of digital goods and potentially are subject to sales and use tax. So making sure that you have a software that can not only flex when it comes to actually picking like a tax code that's typically going to generate what your actual collections are going to be, whether it's taxable, exempt, and what the rate is going to be at, because there are also varying rates depending on what type of category you kind of fall in some of these states. But also just like making sure that like everything is coded, making sure that everything is aligned with how you really need the system to function and operate. And a lot of that comes down to operating in a sandbox or operating in efficiencies to make sure that you test these things, right, before you put it into a live aspect when it comes to actually having these softwares do the collections. But the other side of it too is really making sure that somebody is still kind of health checking it every now and then. You know, we work with a lot of clients that, you know, maybe they instituted a software back in 2022, but the laws have changed pretty significantly. And with that, a lot of these softwares will also add some additional codes, will add some additional taxability options that you could potentially fall under and maybe align a little bit more with the expectation for what the taxability really should be. So making sure that you have a team in play that can actually go back and take a look at these things every so often. And I'm not saying it has to be every month, but maybe, once a year, or if there's a big tax law change that is being pushed out. Withum has a newsletter that we push out with all kinds of tax updates, and there's no shortage of tax updates that we can push out when it comes to these dates between income tax and sales and use tax. So, maybe sometimes having, an additional source out there that you can kind of get some additional information so that you're a little bit more abreast of the changes that are happening in the States has definitely been beneficial for a lot of our clients when it comes to not only just instituting a tech option or an automation option when it comes to sales and use tax, but also just understanding the basics and the foundation of the returns. I think we can go to the next slide. I talked a little bit about exemption certificate management, so I'm not going to spend too much time here, but just to reiterate, really making sure that you have a process in play, whether that's internally or using a software that's going to automate that system for you. Sometimes certain state exemption certificates do expire, right? So that is something that we would have to potentially, address, right? Like there are states that are 3 years, there are states that are 5 years, there are states that are indefinite, right? Making sure that you're getting those forms updated. It's going to be incredibly important to making sure that you're ready for any type of audit that you might have, especially on a sales and use tax side. I can tell you more times than not, we have had clients that have been under audit where potentially they hadn't refreshed their exemption certificates and they had expired, and the auditor has straight up said, like, this is expired, I can't accept it. I'll give you some time frame, 30 days or so, a grace period to essentially get another, but they are not going to accept what is actually on file. So having a process in your firm and your business to make sure that you have the ability to kind of check these things every so often, or when maybe it's the renewal for the contract that you have with a customer, making sure that you have somebody there to not only just accept it but also to validate it. The biggest thing I see more often than not when it comes to exemptions is not having signatures, right? Not having signatures and not having dates. Those are the two biggest things that I see when people accept exemption certificates. So I do think that, potentially you need to have somebody who's going to be able to review those things for you. And I think we can kind of talk a couple more about some audit trends on our next slide. We're seeing a lot of states put out these Jeopardy assessments in response to not answering Nexus questionnaires. I just had one very recently in the last couple of weeks where, it just kind of went to the abyss. Nobody got the mail. It didn't show up in anybody's email, or it showed up in spam. So they didn't respond to a Nexus questionnaire in a particular state. And sure enough, the state registered them, went all the way back to the beginning of Economic Nexus, and was requiring that they filed all these returns and had a Jeopardy assessment of 500 per period, and when you're talking about 12 periods, it adds up pretty quickly over 4 or 5 years, right? So making sure that you're responding to those Nexus questionnaires and that the states have updated information, like mailing information and email information. It's pretty important to make sure that you're getting the things that you need to get from the states when it comes to these types of questions. We're seeing some of the departments kind of upgrade their use of technology when it comes to actually performing these audits. So, some of the things that we've been seeing is like they're applying it when it comes to like the sampling methodology. One of the big states I'm seeing that actually has an entire department outside of their actual auditors that's actually utilizing technology is Illinois. For anybody who's familiar with Illinois did change their rates, or I should say the way that they apply the rates when it comes to collection for remote sellers, where previously there was kind of a little bit of a loophole where you were kind of just applying one single rate. They did institute that everybody had to collect when you were a remote seller at the actual destination rate. So it did drive them to invest heavily in their audit teams, and they are utilizing entire IT teams, for lack of better terms, that essentially do use technology to go through and fine tune every line of your transactions. So we are seeing some departments invest heavily in new technology and ways that they can sample when it comes to testing for sales and use tax. As always, there's immense pressure for these auditors to close audits. Just generally speaking, we've been seeing, I don't want to say any specific state because we've been seeing it across a lot of states, but we've been seeing that there are some states for sure that, just don't have the people to do the audit volume that they want. So they're getting pressure to close these audits quickly, which often is resulting in, some missed items where potentially it's an opportunity for a business or a representative of the business to be able to negotiate, and kind of maybe help minimize the actual assessment when it comes to the audit. So that's kind of where, having the opportunity to negotiate is really coming into play. We are seeing that there is states that are targeting multi-state sellers. So it seems like some of the states are talking to each other. So they are getting information from outside sources to be able to kind of address things. There's a couple states that I've been seeing that actually have been tracking trucks when they have to check in at their truck stops. So they are seeing product move down the line on the East Coast or the West Coast. So that's how they're kind of picking up on particular items that need, or particular businesses that should be audited. So it's just something to kind of keep in mind. So I think we can run to the next slide.
And
So,
before you Courtney, before you get to this, two other quick trends is penalties are getting tougher to waive.
correct.
So I just want to point that out: is the states need money, and they are being. It's real tough, especially if you've had them waived in the past. The other thing is there is a New Jersey has created a new mediation program. So it's a before conference and appeals. So that's another point that it's a pilot program right now. We have one that's actually going to go to that. So we'll know a lot more after that program. But even if it does not work out the way you want in the mediation, you still have the right to appeal in conference and appeals. Go ahead, Corey.
Yeah, so I'm just going to touch briefly on this one. So sales and use tax refunds, there are some vendors out there who may have conservatively been collecting, especially if they didn't have the resources to be able to fine tune whether or not their product is taxable. So they just kind of tax it all. So there's opportunities to potentially get sales and use tax refunds from states in situations like that. There's also exemptions that may be available. The big ones we see are the manufacturing and the research and development exemption certificates, and packaging, I would say, is probably the three biggest that we see, where potentially you may have charged or you may have been charged tax and paid tax, but potentially could be eligible for a refund. One thing I just want to note on this page, and then I'm going to move quickly to the next section, but just generally speaking, when it comes to the refunds, we are seeing that the states are spending a significant amount of time validating information when you do request a refund. So in the past, there had been some states where you just amend the returns and then they kind of give you the money back, right? We are seeing that they're scrutinizing it a little bit further, and you do need to make sure, and the windows that they're scrutinizing it in are very short, generally 30 days, right? So you do need to make sure that you kind of have all of your T's crossed and I's dotted to make sure that you've got the information in the time frame that they want to receive it in.
And one other point I wanted to bring up on the refunds is one other opportunity we list on here is software or other services. If your state taxes services, certain services or software, and the vendor is billing you sales tax, then of course there could be some opportunities out there. We may have some positions if you have people across the country or across the world where there could be some refunds. So again, if you have that situation, you may want to look into it. Again, we're always happy to talk to you about it. Go ahead, Courtney.
Yeah. So I'm going to move to our next section, which is sales and use tax trends. And a lot of it does actually kind of flow with some of the things that I've already discussed. So I apologize if I'm going through the slides too fast, but we're going to go ahead to the next slide. One of the things I just want to kind of touch on is really the vendor compliance changes. So like we've been seeing a handful of states that are actually pulling back on vendor discounts as a whole for when you file timely. But we're also seeing some states put in caps in play as well. Again, I think this is kind of a way for them to kind of, tie out their budgets that they really have. So we are seeing some changes when it comes to actual filing, and we're not seeing as willingly for timely filing discounts. And there's some states that once you kind of cross over to a certain filing frequency, they may actually pull back on that discount for you. So like, for example, New York, once you become a monthly filer or a part quarterly is what they call it, where you have monthly deposits and a quarterly true up, you're no longer eligible for a discount. So we are seeing that occur across a handful of states. So I'm going to run to the next slide. Jim had kind of already mentioned it, and I'm just going to kind of reiterate. We are seeing some states that are eliminating that 200 transaction threshold and defaulting to just the revenue amounts. But on top of that, in general, we're seeing just the changes really in again the digital space when it comes to streaming platforms, ebooks, audiobooks, subscription-based digital content. Maine was the last one or I shouldn't say the last one because God knows there's 2 more months and potentially we could have another one. But Maine is one of the last ones that we're seeing that are going to make a pretty big change when it comes to January of next year. And then, as I kind of mentioned, just there's been an increase in the audits that we're seeing across a lot of the states. One other thing I want to note, and I actually don't think it's up on the slides, but there are some states that are actually considering retail delivery fees, very similar to Colorado and Minnesota as well. So they haven't officially instituted anything, but it does seem like that's probably the next domino to fall across a lot of these states when it comes to compliance, which is generally hand in hand with your sales and use tax compliance. So I think we can roll to the next slide. And one of the things that I had mentioned is a lot of the tax authorities are leveraging third-party data resources, so that could be completely out of the state from vehicle title records, alcohol and tobacco reports. I mentioned the trucks, logs, right? Like we're definitely seeing other resources come into play when it comes to not only who they're kind of targeting for audits, but what they are actually looking for under those audits. And just in general, kind of another area in the taxability round that we're seeing is the scrutiny around bundled and mixed transactions. There really are two different things when you talk about bundled transactions and mixed transactions. We kind of mesh it all in as it's one big thing, but they really are two different things, right? One is going to constitute really tangible personal property and two different types of tangible personal property, one potentially being taxable, one not being taxable. And the other side of it is a mixed transaction where you're really talking about services with tangible personal property. So we are talking about two different things, and some of the states have instituted language in their guidance about how to address those and whether or not you can really take the assertive position of applying a true object or a de minimis test in order to determine whether or not that transaction is actually taxable. So I'm going to run to the next slide. One of the big topics that I still feel like we've been talking about all year, but really hasn't been that long, is the tariffs that have been passed on customers, and whether or not the tariffs are embedded in the price or separately stated, and whether or not they're considered taxable in states. We've definitely seen some states that have rolled out very specific guidance, but there definitely have been a handful of states that, it's not quite clear yet, but potentially we could, see some changes over the next couple months, 2 years. I already mentioned, Washington expanded their tax base pretty significantly. So, if you're a business that is operating in Washington, it definitely is worth just taking another look and seeing what's going on there and if there's been any changes that potentially could impact you. And then, just to kind of highlight, because I feel like everybody's in New York at some point in time, right? New York is potentially well, they've thrown out considerations around streaming services and digital goods could potentially, be taxable in the future. I think it's kind of open for discussion to see kind of what potentially might go out there. So I'm not sure, Jim, if you want to talk a little bit about due diligence.
Sure, I'll talk briefly about due diligence. Next slide. Yeah, so we did want to mention due diligence since we're seeing an uptick in M&A activity as well as fundraising. So if you're planning to buy or sell, definitely consider state and local liabilities and make sure they're taken care of. So we've seen a lot of deals held up for significant state and local issues. Again, if you're planning to apply for funding, the due diligence process will likely consider state and local tax. Next slide. So if you're planning to sell, having grasp your liabilities could certainly help you with negotiations later. You can begin the remediation, the VDAs. You can look at taxability and see if you have any positions to argue. We've had a couple of deals where they had some requirements to actually take care of the issues and not really knowing whether they were taxable or not because there wasn't enough time to make that determination. So you could have some escrow held up while everything's being rectified could be for 18 months to 2 years. So one deal, they had 7 years of funds for liabilities tied up until the VDAs, which limit the look back, the voluntary disclosure agreements, were completed with proof of payment and the VDA agreement signed. So if you do the work ahead of time, you can head off any potential issues. On the buy side, of course, if you don't identify liability during the due diligence, then you're stuck with it. Many companies handle their own due diligence and may not have state and local specialty. Next slide, please. And again, Jonathan will discuss some M&A issues, but these are some of the questions that we ask. Again, where have you filed in, and how were the filing determinations made? Companies' state and local compliance function, describe it for sales use income tax. Companies' revenue streams, we want to know. Has there been a taxability review on them? Where do you have Nexus, or people, payroll, independent contractors? Any mergers or acquisitions? We might want to see the due diligence reports. Did you address it? Obviously, list of ongoing audits and so forth. So again, a lot of questions that we ask because we want to make sure if we are going to be on the buy side, representing the buy side, we want to make sure that we're capturing all of the state and local tax issues or what could potentially be out there. And keep in mind, if we don't know the answers to them, we can't find them out, we have to be conservative on the buy side. So you may have a larger escrow than you actually want. So with that being said, next slide, and I'll hand it over to Penny.
Great. Thank you, Jim. Thank you, Courtney. We're going to talk about income and franchise tax. And the first area we're going to get into is assessing market-based sales sourcing rules. And this first slide is the current map of the US. And you can see there's a lot of blue states on there, and the blue represents states that have moved to market-based sourcing. If we were to look at this, pull this map from 20 years ago, even 10 years ago, the colors would be switched. There's been a trend of moving away from cost of performance, which the green represents cost of performance or place of performance, and moving towards market-based sourcing. And you can see on this map, we are including states that are not just income tax, but there are a couple of gross receipts tax, Washington, Ohio, and Texas, where we've got that on there as well. So the shift has been over the years from cost of performance to market-based sourcing, and the trend continues. There's still a handful of states that are cost of performance, but the challenge is when you've got you've got some states that are cost of performance and some states that are market sourcing. First, let me just discuss, there's several that are switching over this year. Massachusetts was 2025, Arkansas 2026, and Kansas is 2027. So they are moving. And back in the old days, I like to tell my kids back in the 1900s, before the internet and when businesses were brick and mortar, and it made sense to determine the connection to a state based on property, payroll, and sales in a state. They were cost of performance, and now business has changed with the internet. There's states are wanting to get a piece of their action from internet and online sales and services that are being provided across state lines. So when you ask what is market-based sourcing, it is the revenue is based on where the benefit is received or the market for the service. For tangible property, it would still be the destination, generally for the product. And so it can either be based on where the benefit's received. Some states say where the benefit is delivered, where the service is delivered. And there are still a handful of holdouts to cost of performance. And there can be implications for multi-state businesses when you have two different cost of performance versus market sourcing. It creates a risk of either having double taxation or non-taxation, or what we call nowhere sales. And an example of this might be if you are if you have New Jersey, a company in New Jersey, and your people are in New Jersey, and they're providing a service to customers in Florida, then Florida is a cost of performance state. New Jersey is a market sourcing state. So New Jersey says the sales are in Florida. Florida says the sales are in New Jersey. So that is an optimum situation where you have nowhere sales. Whereas if you would switch it and provide the services in Florida for a customer in New Jersey, both states say that the revenue should be sourced to that state. So those are the complex situations that you can run into when you have a system of both cost of performance and market-based sourcing, and you're doing multi-state business. With the sales factor weighting, most states are moving toward a single sales factor rather than bringing in property and payroll. Using the 3-factor system of property, payroll, and sales is somewhat of an outdated concept, in that if you're an in-state provider, you're being almost penalized. You're paying a higher tax rate. You're paying more apportionment because the property and payroll is included in that factor, and it bumps up the apportionment. Whereas an out-of-state service provider or business is just being taxed on the sales alone. So that is an increasing, because of the nature of the business community and the way that we operate on the internet and with multi-state businesses, single sales factor is more prevalent. And usually a state will take a multi-year process. Like Tennessee in 2024, the weighted sales were 11. It is a 3-factor state, so property was 1, payroll was 1, and sales were 11, weighted by 11. And so next year they're moving to a single sales factor. So usually the states will take a couple of years to transition. The things to considerations are to look at your Nexus footprint. Are you in New Jersey providing services to Florida, or are you the other way around? Is there things that you can do to one project I've done for a client was I had a go, no-go list for a national company that had employees in a number of states, and they wanted to know what states shouldn't they look for employees in to allow for remote employees, because they didn't want to create Nexus in new states. And another thing to look at is for internal systems for sourcing accuracy. If you are in a state like Virginia or Florida, Texas, where it's cost of performance, making sure that you have systems in place to track the sales, the cost of performance, and what the people in that state, the income that they're producing versus it's easy. Usually we get a sales by state that's market sourcing, and what's the customer's billing address. So making sure that you have system in place to capture the correct amount that should be sourced to a state. And market sourcing, the increased audit scrutiny, that's a common thing that you're going to hear about throughout the whole presentation, is that states are running out of funding and they need to collect. So there will be more audits, and making sure that you have done the research and you've documented your position going forward. And some key challenges and what to look for. The biggest change, it's a relatively new concept, this market sourcing, and it hasn't been litigated a lot in the courts. The judicial interpretation section shows a couple of them, but it's a relatively new concept. So states are looking to define what the market is, and there are new look-through rules that are going to complicate that. And the most recent, California is the one to expand their rules in this area. And so beginning in 2026, 1/1/26, California changed the rules for asset management So for asset management fees, particularly, they added a concept of beneficial owner. So in sourcing management fees, a fund that has multiple owners will need to look to the beneficial owner. So that is an example of look-through sourcing and looking through the fund to the beneficial owners. And so that's going to require additional record keeping and another level of in creating the sourcing for each of these clients. And another change with the California rules is with professional services, and they've listed the specific professional services examples: accountants, lawyers, consultants. They will be allowed to there's more defined rules, and they're allowed to, if a professional service provider has more than 250 customers, then they are allowed to use the billing address to determine where the benefits received. So states are looking to define more clearly where the benefits received and or where the service might be delivered, depending on how the state defines that. And the two cases that are listed there are examples of how the court is interpreting. Again, it's a new concept, relatively new concept, so there haven't been a lot of cases. So we're starting to see them. The cases where, so in Pennsylvania, a court upheld where the customer receives the benefit, even though it was under the partnership cost of performance rule, or maybe it was, it was when it was under the cost of performance rules. They're under market sourcing now. But we saw a similar big court case, the Sirius XM in Texas, where there was a discrepancy between interpreting the cost place of performance rules versus where the service is being delivered. So those are two aspects of market sourcing to be on the lookout for. And again, for the future, there's a trend. The trend is going to continue for market-based sourcing. It's just a matter of if those last holdouts are gonna switch over. And there's a need for clear statutory guidance and robust documentation in making sure that when you are taking a position for market sourcing for a particular state, that you've documented that position in the case of audit. And the topic that everyone is talking about, the One Big Beautiful Bill. We have there's a couple of impacts, several. The main thing to look at when we're looking at the One Big Beautiful Bill is the state conformity. And so the main changes at the federal level expanded the tax base, made some permanent. I'm not going to go into the specifics of each thing, but it lowered some rates, expanded the tax base, and the states are already challenged with meeting their budgets. So the states need to decide what they're going to conform to and how they're going to disconnect from the federal rules. So let's go to the next one. So in terms of conformity, there's three types of conformity. There's rolling conformity, where a state will automatically conform once if the Internal Revenue Code is changed, they automatically conform. There's a static conformity that it's based on a specific date. The legislature gets together every year and says, we're going to conform as of 12/31/24. And then that's the conformity date. And anything that happens after that is not state law. And then there are states, looks like there might be a typo there, but the states, there are specific provisions that some states, there are specific, they conform to specific provisions and some not others. And the trend that we're going to see going forward is that the states are going to can't afford necessarily to conform to everything with the OB3. And this the map that you see here shows how the different states conform to the Internal Revenue Code. And, it's a mix. It's, the blue states are on rolling conformity and the yellow states have a fixed date or specific date. And so it will be, as of right now, a state like Montana, Oregon, Alaska, they are automatically have adopted the OB3 just based on their the rolling conformity. So those states, when they get together in January, need to determine how either they're going to fix their rules to conform specifically, or they are going to deconnect to the OB3. So that will be an interesting development going forward. The salt deduction limitation is for the TCJA, it was changed to $10,000 on the Schedule A that individuals were allowed to deduct, and under the OB3, it's increased it to $40,000 is the gist. It does phase out beginning at $500,000, but that was a big impetus for instituting the pass-through entity tax election. And so this is one thing that we need to look at now that the OB3 is passed and it's the limit has increased and it's been made. We need to address whether at the individual level, is it still beneficial to elect into the pass-through entity tax, or is it not? If your income is over 500,000, 600,000, you're still going to be at 10,000. So it's definitely going to still be a benefit to make that pass-through entity tax election. But we just need to reevaluate whether the partners and owners in a pass-through entity will still benefit from making the election. And a number of states, the PTET regime is scheduled to sunset. If the California just recently passed it and extended it for 5 years, so it's now available through 2030. But there's a handful of states where it's set to expire December 31st of this year. So those the 4 states listed there, their legislature either needs to re-up and extend, or that those states you will no longer be able to make that election. So let's move on to the next. So the next big change that we need to look at is the bonus depreciation. And under the OB3, the 100% bonus is made permanent. And there's some considerations for the state. Before I get into that, just wanted to point out that the January 19th date, it's anything contracted after or put into purchased or after January 19th of 2025. And so the state considerations to consider, most of the states have already passed laws, whether they either conform or don't. They have their own regime set up. So decoupling is expected for the OB3 changes and to follow suit for what's already there. And so the next big one for companies is the Section 174. We've been looking for this to be changed since it came into play a couple of years ago, and that got taken care of in the One Big Beautiful Bill. So previously under the TCJA, all the capitalizing and amortizing of R&A expenses were required over a 5-year period, and the new rule allows the option to either continue capitalizing or to expense in the current year. And there are some states that have already decoupled from the original Section 174 under the TCJA. So we'll see if they changed anything. There is an option in under the OB3 to allow for an amended return for 22 and 23 for entities that are under 31 million of gross receipts. And the deadline to do that is July of 2026. So we'll see if how the states respond to that, whether they, because if you change the federal income, you're required to change the state income. And so if the state is not on rolling conformity and the state hasn't yet chimed in on how they're going to react to Section 174, there could be issues related to the timing that a state return is required a certain number of days, 30, 60, 90 days after that federal return is amended. So that's one thing to consider if the company is looking to amend those prior year returns. And the last thing that we're going to talk about with the One Big Beautiful Bill is the QBI deduction that was made permanent. So the percentage didn't change, but it's made permanent. And there are only a handful of conforming states, and it's another one that the states will need to decide: are they going to continue to conform? Are they going to conform now? What's their position going to be? And now Jonathan's going to talk about the digital services. Take it away.
Yep. Thanks, Benny. So I always say in this area that states know how to tax Blockbuster, and they're very comfortable at how to tax Blockbuster, but they haven't really figured out how to tax Netflix. Problem is, Blockbuster is gone. The last one is in Bend, Oregon, but Netflix is here to stay for at least the foreseeable future. So, that in the first box, an interesting tidbit is that CD sales, vinyl record sales exceeded CD sales in 2022 for the first time since 1987. So basically, the digital space has become intangibles. So there's no longer tangible personal property being sold in the digital economy, and that is affecting things like Nexus and apportionment. So number one, if you're no longer selling tangible personal property, 86272 doesn't apply. And second, you have all the issues of how to source your sales. When you're dealing with individuals, the only thing you might have is billing address. But when you're dealing with business-to-business sales, you might have to start looking at user location and knowing where that username and password resides, and start sourcing along those lines. Similar to what we see with the multiple points of use in sales tax. So again, this is going to be the future. Hardcover books are starting to go away; they're being replaced by ebooks. And again, the MTC is working on model definitions, but states are going to come up with their own ways of how to source these items and how to tax those items. And again, states are struggling to expand their tax base to include things like software as a service, platform as a service, infrastructure as a service, because the legacy analog transactions are no longer occurring. I used to be the person that I couldn't go into Costco without walking out with at least a half a dozen DVDs. Costco doesn't even sell DVDs anymore. So nobody wants them. Everyone just wants to stream and have everything on demand. But now states have to figure out how to treat that. So we'll go to the next slide. So again, we have Public Law 86272 in the digital age. So Public Law 86272 is a 1959 federal law that says that if your business engaged in the sale of tangible personal property and your order is accepted and fulfilled from outside the state, that the destination state may not impose a tax based off of net income on that business. The problem is that physical transactions are slowly disappearing. Now, of course, we're always going to buy some physical goods. Everyone's going to go out and buy bread and eggs and groceries. But when it comes to other types of transactions, media, information, ideas, this is becoming digitized. And these transactions are no longer occurring in physical form. So again, if you buy that streaming service, if you buy that download book for your Kindle, those are no longer physical transactions. Those are intangible transactions. And so 86272 doesn't apply to those. But on top of that, the MTC has recently revised their guidance on how to treat the digital economy and many other internet-based activities, according to the MTC, also break 86272. So, for example, having chat support or placing cookies on on a customer's computer or providing software updates are all unprotected. Now some of these things, if I buy a box and that box comes with software updates, I think that the consensus is that likely breaks 86272. But some of the MTC's recent restatement, they are controversial. That for instance, having chat support breaking 86272, where I could have an 800 number and people can call me for customer support. Well, that seems to run afoul of another federal law called ITFA, which is the Internet Tax Freedom Act, where states can't burden e-commerce more than they do legacy commerce. So it's going to take a while and a lot of litigation to sort out the MTC's restatement. And again, so we've seen Massachusetts, New York, and New Jersey have adopted or proposed regulations aligning with the MTC's interpretation of Public Law 86272. There has been litigation in some of these states already challenging the state's adoption or how they are applying Public Law 86272. California also said that they're going to adopt the MTC's interpretation of Public Law 86272, but that was voided by a court, but on procedural grounds. Basically, the court held that California did not follow their Administrative Procedures Act, and therefore they couldn't do that. But it would be a simple matter for California to just go through the motions and follow the Administrative Procedures Act and then adopt the MTC's version of Public Law 86272. So it remains to be seen what's going to happen in California. But I anticipate we'll see some movement on that in the coming months. So moving to the next slide. So again, states are narrowing protections. So from Public Law 86272, again, New York adopted the restatement, but they wanted to say, well, this is retroactive to I think 2015, and the court said no, you can do this prospectively, but you can't do it retroactively, and you certainly can't do it retroactively for over 10 years. There is proposed federal legislation to expand Public Law 86272 to protect internet-based solicitation activities like online support and digital tools. There is other legislation that might expand Public Law 86272 to ancillary services. But those are very vague statutes, and if they were enacted, it would probably guarantee a decade of litigation. And again, businesses are challenging the state interpretations, and courts are certainly struggling with whether any of this can be applied retroactively. Again, since the MTC didn't come out with this reinterpretation until 2021. So moving to the next slide. So that's going to take us to SALT considerations for mergers and acquisitions. So the question is always, well, who can tax a transaction? If I'm going to sell my business, who are the states that can then tax me? And it's basically all the states where the business operates, which can include the states where my customers are, even if I don't have physical operations there, and also the states where the owners reside can certainly tax that transaction. So if I have a single location and I live in the same state where my single location is, ultimately that becomes a very simple transaction because my business, I own a 7-Eleven. That 7-Eleven is on the corner in New Jersey. I reside in New Jersey. That transaction can only be taxed in New Jersey. But as soon as I have multiple locations and customers in multiple states and owners in different states, you get to a very complex transaction very quickly. So moving to the next slide. So dispositions generally fall into two categories. So you have asset sales and equity sales. So, although we should note that the sale of an interest in a partnership or LLC treated as a partnership is generally treated as an asset sale for income tax purposes. Now, for legal purposes, that is still an equity sale. That whoever the buyer is, they've bought the equity, they've bought those units, they step into the shoes of the seller. But again, for tax purposes, that transaction is treated as if the buyer bought all of the assets of the partnership or LLC, and they get a step up in basis in that transaction. So moving to the next slide. So asset sales, just because you're buying all the assets doesn't mean that there are no complexities. Actually, there's significant complexities in an asset sale. The first one being is that if you're buying the assets of a business, you may trigger sales tax. Not all states have an occasional sale exemption. Some do, some don't. But even if there is an occasional sale exemption, a seller may not qualify if they are registered for sales tax. So sometimes an occasional sales tax is only applicable to someone who ordinarily isn't making taxable sales. Or again, occasional sales exemptions may only apply if you've only had 2 occasional sales in a year. So if you have prior asset sales in the same year, you had a client that was a health club, they regularly dispose of obsolete equipment, and when they're bringing in new equipment, well, they couldn't qualify for the occasional sale because they had too many asset sales. And I'll also note that again, if you are doing an asset sale deal, that may require bulk sale notifications to the state. So moving on to the next slide. So asset sales, there's also issues on sourcing gain. Physical assets, that's usually pretty easy. I mean, you should know where your physical stuff is, and that's generally sourced to the location, where it was located on the date of sale, which again could create issues when you're dealing with mobile property. But again, physical stuff, you usually know where it is, even if it's mobile. But there's complexities in that where, again, you might have different state versus federal basis. For example, almost every state decouples from bonus depreciation, which means that you may have a very different basis for state purposes than you do for federal purposes. And you need to track that, because if you just use your federal basis while you have additional state basis, you're going to wind up paying too much state tax. Then, of course, there's always complexities with regards to how do you source intangibles, which could include goodwill, patents, trademarks, know-how, customer lists, working capital, and receivables. That could get sourced into all different kinds of ways. And sometimes it's by use, where the seller is domiciled, where the buyer is domiciled. It could be excluded from the apportionment factors. It could be included in the apportionment factors. You might need to use a multi-year average of your apportionment. Every state has a different way of doing this. So again, when you have transactions where a significant amount of the assets sold are intangibles, you need to do a state-by-state analysis as to how those intangibles will be sourced. Again, some states exclude sales outside the ordinary course of business from apportionment. It's one thing to sell a widget, one at a time, but if you sell all of your widgets, that may be excluded from both numerator and denominator representation, because that's not a typical sale. And timing when you're dealing with asset sales really matters, because if I'm going to look at, well, where stuff is and what I did, and if this is going to be excluded, doing a deal on 12/31 versus January 1st can really change what the sourcing looks like in many states, especially states that exclude non-ordinary sales from the measure of apportionment. Because if I do a deal on 1/1 and this deal is excluded from the measure of apportionment, and I didn't get around to doing anything else, my apportionment may look very, very different than if I had a full year of activity behind me. So moving on to the next slide. So again, asset sales, a lot of people say, oh, I'm buying the assets, there's no successor liability. And I do have to point out that that is not always the case. So many states say that if a buyer buys substantially all of the assets of the business, It's no different than if you bought the stock of the business, that you may inherit those tax liabilities even if you didn't buy the shares. And so whenever you're doing an asset deal, it is important to consult counsel and figure out what is your successor liability and perform your due diligence on what your inherited liabilities might be. You can't just ignore it and sweep it under the rug and say, "Oh, I only bought the assets. I'm not going to be on the hook for the sins of the seller," because you might be on the hook for the sins of the seller. And of course, nobody wants to buy a problem. So again, just because you're buying the assets doesn't mean that you don't have some level of successor liability. And it's important to understand what level you do have when you go into a transaction. So maybe the next slide. So again, equity sourcing. Uh, so you're dealing with C or S corporation stock sale. That is generally only sourced to the seller's home state or state of domicile. Again, there could be different rules for a C corp selling a subsidiary. But again, if you're dealing with individuals selling C or S corp stock, the general rule, the base rule, is that only goes to their home state. In essence, it's really no different than they sold Alphabet or Google or any other publicly traded company on an exchange. Although there is complexities, especially when there's equity-based compensation. Equity-based comp is generally sourced to where it was earned, not necessarily where the shareholder lives on the date of sale. And there could be potential withholding issues on that. Again, as we discussed, a partnership or an LLC sale, if you sell 100% of the units in a partnership or an LLC, it's treated as an asset sale for tax purposes. And again, that generally has to roll through the apportionment of the entity and can very easily be taxed in every state or multiple states. And again, whenever you're buying the equity, now you definitely buy you're assuming prior tax liabilities as well as really all the liabilities. So when you're doing an equity deal, due diligence is critical because again, you do step into seller's shoes and you eat all of their prior sins. So no one wants to buy a problem, or if they are going to buy a problem, they want to know how big that problem is and figure out how to mitigate it. So moving to the next slide. So equity sourcing, there is also the concept of a 338H10 election, where you treat an equity sale as an asset sale and the buyer gets a step up. I will throw out that not all states recognize 338H10, so there could be some benefits from doing that, like in New York City or DC that don't recognize subchapter S. That is simply a sale of stock, and a 338H10 transaction won't get sourced there. But again, the 338H10 election generally increases the seller's tax liability. So, there might need to be a negotiated step up and price adjustment for the additional tax being incurred by seller. And then there's also complexity for non-resident S corp shareholders. The first Covell arrangement I ever did was how to compute damages for the S corp sellers that did a 330H10 because they wound up paying New York State tax on 120% of their income because they didn't do it right. So again, if there is a loss on liquidation, that bumped their New York non-resident ratio up to 120%. So you really need to be very careful when you're making these elections and map everything out and know what it's going to cost everyone. Moving to the next slide. So one other thing to keep in mind with real estate, with M&A is incurring real estate transaction tax. Asset sales will almost always trigger real estate transfer tax on owned realty. The majority of states, there's no real estate transaction tax on regular leases, but some states tax real estate transaction taxes on long-term leases. Something with more than 20 years or 25 years included options to extend. There's one state that's 99 years. Again, if you have a 99-year lease, you pretty much own the property. But I will point out in New York, real estate transaction tax may attach to any lease with value. And a lease with value is a lease where the contract rent is less than market rent. And again, when you do an asset deal, you may need a valuation to determine the tax base for a real estate transaction tax, and that could also apply to a controlling interest transfer tax. That again, about half of the states that have a real estate transaction tax will impose that transaction tax when there is a material shift in the value, material shift in the beneficial ownership of the entity owning the real estate. So moving on. So again, actually, I already touched on this. So again, about half the states that have real estate transaction tax apply it to interest transfers and entities owning real property. And again, the calculation may differ if it's a controlling interest transfer versus a straight up sale of a deed. So moving on to our state predictions for 2026.
All right. So we both Jonathan and I have touched on this, that there's going to be a lot of activity in legislatures in beginning in January when they reconvene, January 2026. So in terms of the OB3 provisions, we can expect the rolling conformity. Like I said, they've already conformed, but we expect those states to decouple from one or all or a number of them. For example, Rhode Island has already decoupled. Traditionally they conform to the Internal Revenue Code. It's rolling, so they rarely have decouple, and they've already decoupled from 174. And again, states need to address how they're going to conform to the One Big Beautiful Bill. And another trend that we're looking forward to is the transition from progressive taxes to flat tax adoption. There's a number of states listed there where it changed in 2025, and down below, Kansas, Ohio, Georgia, Pennsylvania. Pennsylvania went to as a gradual 0.5% reduction over the next several years to get down from a high level, close to 9% down to close to 4%, just under 4%. So the state taxes, the rates are lowering and the tax base is shrinking. So the states are going to need to react to that. The other thing that we're looking towards is a lot of talk. The talk of the town in the state tax world is AI adoption, and how the state tax departments are going to utilize or not utilize AI. And there, in general, there's a hesitation to put any PII, any personal information, in the AI, any AI tools. So states are developing laws, and for the most part, the state tax departments are using AI to be more efficient, potentially help with the fraud detection and compliance, and those manual tasks of finding errors in returns. They're using AI for that potentially, but not necessarily. They don't want to drop any. They don't want to have any personal information in the AI tools. So look for a lot of talk about AI and state legislatures passing laws related to protecting taxpayer information related to that.
So going into residency rules and remote mobile workforce, there is federal proposal out there, Senate Bill 1443. That would prevent states from taxing individuals unless they work in the state more than 30 days a year. This legislation is supported by the AICPA, COST, and the U.S. Chamber of Commerce. We'll see if this moves. I mean, right now, the current Congress can't seem to agree on very much, so getting them to agree on this could be very difficult. But right now, there's 22 states that require filing after working in the state after only 1 day. 15 states require employer withholding after 1 day. And there are 7 states that have a convenience of the employer rule, such as New York and Connecticut. So again, this is, as more and more work goes remote and people start traveling, the complexity on how to deal with employee travel and remote employees is only going to get more complex. Let's move to the next slide. So again, the escape from New York continues, and based off of last night's election, I expect it to continue to pick up. According to the New York Post, roughly 750,000 people say that they're definitely going to move out of New York City if Mamdani won. That would be the equivalent of Denver or Nashville or Washington, D.C. That's how many people that would look like. But even if only 1 in 5 of those people go through with it, that's still 150,000 people, which is the equivalent of, say, Savannah, Georgia, or Gainesville, Florida, or Waco, Texas, or Syracuse, New York. So you're talking about a lot of people that are looking to essentially resort themselves into a place where they prefer to live, based off of quality of life and cost of living. So moving to the next slide. So again, like I said, the Great Migration is going to continue, and I anticipate that over the next 2 to 4 years, it will only continue to accelerate. And I think we're going to see the same migration patterns from the dark blue states to the redder states, and Florida, Texas, the Carolinas will continue to pick up population, whereas some of the northeastern states that are tax unfriendly, climate unfriendly, and business unfriendly are going to continue to shed population. Moving on to the next slide. So again, quick rundown. But again, this is why residency matters. So residents of a state, they're taxed on 100% of their worldwide income. That means everything, and they're also subject to state-to-state taxes. Non-residents only tax on income derived from sources in the state, and they're only subject to state-to-state taxes to the extent that they own property located in the states. So if you don't want to share your estate with Governor Hochul or Governor Murphy, the way to do that is to move out of those states and the states that don't have a state-to-state tax or a state death tax. Moving right along, I think we're 1 minute over, and yep, got it right on the dot with 1 minute over. So again, please remember to sign up for Withum Salt Leadership, including the Dash of Salt. These are all your presenters. We're here to answer your questions. I apologize, there were some great questions asked during the session that we didn't get to, but we'll respond to those offline. So thank you very much.